The main theme dominating the markets at the moment, other than obviously the Delta variant, is the issue with inflation and particularly how bond yields are currently reacting to rising inflation and how the Fed may react in the future because of inflation. Now, it's all a bit of a strange situation and there are all kinds of opposing theories about what's going on, views about whether it's a problem or not and what the Fed should be doing about it. So in this video, I wanted to go through a bit of an update and see what's really going on. There are some really interesting talking points about the current situation that I want to cover, some great detail. There's going to be a lot of details to talk about, in fact, but it all ties together. So stick with me here. Let's go down the rabbit hole. And we're going through a heat wave here in the UK, so I've got to have a fan on right next to me, otherwise I'm going to melt. I hope it's not going to pick it up in the sound, but sorry if there's a hum in the background. So let's start with the inflation reading itself in the US. Last week's release of CPI showed that headline inflation for June was 5.4%. Now, as we discussed in our video last week, this was the biggest jump since 2008. It had a lot of people concerned, and of course the mainstream press sensationalized it, but many people also completely downplayed it and said it's actually not so bad. But on Friday, consumer confidence figures came out and showed that there was a sharp drop, apparently because of inflation concerns. Similar sentiment was stressed by members of Congress last week when the Fed chairman Jerome Powell had his congressional testimony. Frank Lucas, for example, a Republican, said that he was nervous and will be sleeping with one eye open until numbers come down, as if big bad inflation is going to be coming after him in his sleep. But across the board, there were comments about constituents feeling concerned right now. But then on the other hand, you have Jerome Powell responding by saying that the Fed still believe that inflation is transitory, it's temporary. Although he did say that he understood the concern and it took them by surprise, but they would have a better grasp of the situation and the data in 6 months' time. Now, that's a long time to wait, especially when the financial media are now dwelling on inflation, which could cause concerns for the public that would lead to some very vocal lawmakers. But we'll come back to that issue in a minute. Powell also said that the higher than expected inflation figures had caught the Fed off guard, but it's the same story of certain parts of the economy causing this inflation. Bottlenecks in supply chains, short-term boosts in demand due to lockdown measures being eased, and so on. And when we look at the data, we can definitely see that that's the case. Travel-related costs like airfares, hotels, car rentals are rising. Energy prices have obviously been on a bit of a tear up, largely due to the situation with oil, although we have seen over the weekend that OPEC Plus have agreed to increase production by 400,000 barrels per month from August onwards. It's still a relatively small increase compared to the potential for increased demand, but it's a good starting point. We've even seen things like shipping containers being at record high costs due to a shortage and a backlog in getting container ships discharged at major ports in the US. The composite index of 8 major routes last week was at almost $9,000, which was a rise of almost 350% compared to the same time last year. That's a huge one-year rise. So of course, these things will lead to a larger level of inflation. But you'd expect that over time, the prices of these things will start to come down. Although it has to be said that the shipping container situation in particular is expected to go on until next year. But I guess in a way you could say, it depends on the timeline of what you think is temporary or not, but you could say that even if it goes on until next year, it's still temporary. So inflation there could be transitory. Stephen Englander, the head of North American macro strategy at Standard Chartered, calculated the underlying US inflation rate by stripping out all of the sectors like new and used vehicles, car rentals, hotels, airfares, and the more volatile food and energy costs. And as a result of this, he found that the month-on-month underlying inflation rate was 0.22% rather than the 0.9% reading that we saw for June. And if we look at this chart from the overshoot that was actually posted in the FT, underlying inflation isn't that far above the average from the past 25 years. So perhaps this isn't so much of a concern. And of course, this isn't just limited to the US either, but in some ways they are the first ones through the door. In the UK, we saw inflation rise above expectations and hit 2.5% last week, but it seems that the UK is following the US trend, delayed by a few months. So this gap between the US and the UK is expected to close towards the end of the year as UK inflation reaches around 4%. At the moment, the Eurozone is quite far behind. After being negative last year, they've now seen inflation rising, but not in the same way as in the US or the UK, possibly due to their delay with their vaccination program and reopening the economy. So again, later in the year, we could see their inflation picking up as well. But the Bank of England is actually in agreement with the Federal Reserve. They suggest that this is sort of just a temporary thing and they aren't wanting to take action too soon. Although they're now actually being pushed to give better justification for thinking that that's the case by the House of Lords, after the Economic Affairs Committee released their report last week on quantitative easing. And it's worth noting that this committee also includes the former governor, Mervyn King, so its criticisms of the central bank will hold some weight. Now, they say that the Bank of England has become addicted to QE as a solution to all economic problems, and actually the current round of QE may now become inflationary. Since the economy is growing, there's substantial government spending and high levels of private savings, they could be amplifying an inflationary situation. On top of that, they threw in a little bit of drama by suggesting that the Bank of England was actually using QE to finance the government's deficit during the pandemic, and therefore their independence needs to be questioned. Ouch. The Bank of England obviously responded by rejecting this claim, but still, interesting points. This committee said that the bank needs to consider the side effects of its actions, particularly the fact that they've artificially inflated asset prices like company shares and houses, which they say has disproportionately benefited those owning them, okay, goes without saying, and therefore caused more wealth inequality, something that we spoke about in the old Market Movers videos when it was on the Duomo channel. And on that note of the housing market, let's get back to the view of what's been happening in the bond market and what central banks should be doing about it, or what people think that the central bank should be doing about it. So the bond market activity has people pretty stumped at the moment. Yields continue to fall despite inflation rising. This isn't how things are meant to be. US 10 years are basically having a negative 4% rate at the moment. Now, of the different opinions out there, a lot of them are about anticipating that the Federal Reserve are about to make a mistake and that's going to affect the long-term economy. So that's what people are suggesting is the reason for this. But even these views of the Fed making a mistake don't all line up either. So basically people are suggesting that either the Fed is going to make a mistake by taking action too fast, or is going to make a mistake by taking action too slow. Now, there was a great article in Bloomberg last week by Mohammed El-Erian suggesting that the Fed should already be taking action right now. He says that there are parts of the economy already overheating, such as real estate, and it's meaning that many Americans can't afford new homes. So he thinks the Fed should start to scale back the mortgage part of their $120 billion monthly asset purchases already, since there isn't much economic benefit of them now, and he fears that if the Fed doesn't start taking smaller action now, they'll have to take heavier action later on to compensate for it. So this is where the issue comes in, because that could be the catalyst for a recession. And this is echoed by BlackRock's Chief Investment Officer for Global Fixed Income. He says policy adjustments that are intentionally late can create distortions in the economy that ends up undermining the successes that the policy achieved until then. He also points to the housing market, saying that new home sales have fallen 23%, and the Fed should already outline its tapering program now, since the economy is already close to maximum employment in terms of job availability. And obviously that's something that the Fed keep outlining, that they're focused on achieving full employment. But interestingly, a new index from JP Morgan that looks at Fed speak found that the Fed does move the market when they speak, when they come out and make statements in the media, except when they're discussing unemployment. Just an interesting side note for you. Now, when it comes to tapering, most people expect that the Jackson Hole Symposium could be the date that the Fed start to outline their intentions, even though Jerome Powell has said that they would continue their discussions about tapering at the end of this month. But back to the piece from the BlackRock Chief Investment Officer, he went on to point out that there are three things he's concerned about. Inflation being stickier than expected, higher prices for basics like food turning into a sort of regressive tax that reduces demand, and high asset prices stifling markets like the housing market. And as an economist at Berenberg Bank said, at the moment the risk is modest, but throughout history, all periods of high sustained inflation appeared temporary at first. But then there's the other side of the discussion, which is about the Federal Reserve being too quick with their actions. Remember earlier I said that I'd come back to the point that Powell said that they needed 6 months to get a good grip on things. That might be a bit too long. And if pressure increases between now and then, maybe they'll be rushed to take action. Well, Powell has been adamant that they won't rush any action. They won't be forced into it, they won't rush. But history says otherwise, and the market may be inclined to believe history rather than what Jerome Powell says, because central bankers, they say a lot, but actions speak louder than words. And for the past 40 plus years, the Fed has tightened more than the bond market has shown is necessary. So the market is betting that once inflation reaches an uncomfortable level, the Fed will raise rates more than they should, and that will kill the economy over the longer term. So this is the risk with reactionary actions. If things get out of control before the Fed has a grip on what's going on, then they might do too much too soon. But for them, it's like damned if they do, damned if they don't. If they wait too long, they risk overcompensating in action. If they go too soon, they might take excessive action too soon that's unnecessary and stop any economic growth. And then the final point that I wanted to discuss, and I have to give credit here to Robert Armstrong at the FT. His daily column is like a revelation. I definitely recommend reading it each day. I'll link the article that I'm referencing here in the description, as it will explain this whole theory better than I can. I'm no bond market expert, but I'll just go over the basics of it here. So this theory is that the bond market isn't telling us about the economy or what the Fed might do wrong, but instead it's entirely based on the current complex supply and demand situation. So in effect, the bond market isn't telling us what the Fed is going to do, it's telling us what the Fed is already doing. Liquidity is being pulled out of the system right now. In Europe and China, there's a slowdown in asset purchases, but in the US, the drop in liquidity is actually due to a sort of reverse QE. The Treasury raised lots of money and put it aside, but is now spending that in the economy. The Fed is worried about money market rates going negative in a market full of cash, so it's absorbing liquidity with reverse repo operations. And if you don't know what the repo market is or how it works, check out the video that we'll link up here that we posted a little while ago on the Duomo channel. So basically, the Fed says that this is just a technical operation, but it's being suggested that this isn't just a technical operation, this is actually a reverse QE at the short end of the curve, and is therefore sort of like a secret tapering that's going on. So, as liquidity reduces, the demand for treasuries increases, which pushes down long yields, as we've been seeing happening. However, the higher demand right now isn't being met with greater supply because the Treasury isn't issuing a lot of long bonds net of the Fed purchases. So overall, the rates are behaving the way they are due to supply and demand, not what the market thinks of the economy. Now, as I said, to understand it more, check out the article I'll link in the description box. There are some great charts there and it's explained in much better detail. And I'd recommend reading that column each day. It's one that I make sure I find the time to read. Now, as of today, we can see that US stocks are dropping heavily and the US dollar has been gaining. According to the CFTC, net long positions on the dollar index reached the highest levels in more than a year as people favor the dollar over the euro, GBP or the yen. This is largely thanks to the Fed seemingly becoming more hawkish, but a lot of the action we're seeing today is also due to the rise in cases around the world and the spread of this Delta variant. So there's an overview of the current situation. I know we rushed through a lot of detail there, but hopefully it's enough detail that you picked up to give you more of a full picture of what's going on. And I think it's really important that we consider different points of view here, as it's a really interesting time with a lot of disagreements between differing positions and very justified different points of view. But this sort of situation also has the makings of some huge opportunities or potential losses if you get caught out. So understanding as much as we can is critical. But let me know your thoughts on this hotly debated topic in the comment section down below. Hit the like button if you found this useful, and please do share it with other people who need to be informed on the current situation with inflation, rates, and the central banks and all of that kind of stuff. Links to our free training are in the description. Thanks a lot for watching, and I'll see you in the next one. Take care, guys. Now I can melt.